Yeah, I'm not sure how to start this one. So I'm going to start this with a chart that I kind of drew up over a year ago. It was around about a year ago. I think it was March of 2024. And it's part of a GAN study I was doing. And this is the history of the S&P 500 from 1929 until current area. It's a screenshot because TradingView deleted my chart for some reason. So we're going to go with the picture that I have of it. So just thinking about the chart like mathematically in the manner which W.D. Gann used to do, um, he equates time with price and has a method of trading according to that. So what I did was take the peak of the 1929 stock market and measured forward 146 bars or 146 months because we're on the monthly chart here. The it ended up being 1,146 months would have landed you right at March of 2025, which is why I kind of expected 2025 to be tumultuous, to say the least. Maybe worse, but this whole pattern may be completing from 1929 till now, and it may be a gigantic cycle. So, 1,146, you take that, I did the calculations up here, 1,145.9 months, multiply that by pi, which is 3.14 whatever, and it equals 3,600. So you take the 3,600 divided by 10 equals 360. 360 is one complete circle, which is why I have the circle around there. So is the price of this asset making a complete circle? In essence, is the U.S. economy coming full circle to where it started? Also have these lunar phase cycles, which work a little bit different than the monthly. It ends up being a 27-day cycle. And from 1929, from the low, which would have actually been 1932, until the same date, you would have 1,149 or 45.9 lunar phase cycles that would have came to the same date, March, like the beginning of March of 2025. So I had this a year in advance thinking, well, we're going to peak out somewhere around there, which the price got pretty close to it. I was speculating that we would get 10 times the value of the 2009 low and potentially 3 times the value of the COVID crash low, which would give a nice mathematical, 6,600 area. So as of right now, haven't gotten that high in price, but I bet you we came pretty close to this trend line and hitting there. As I said, I don't have it on the TradingView chart anymore as they deleted it, but this all kind of lines up, and you're up against this resistance here from 100 years back. Does that have any significance now? I don't know, but I find it very interesting of the 1,146 months equaling a 360 coming full circle in the S&P 500 and Dow Jones. So coming full circle, something that's happening right now is these new tariffs that are getting put on to the tune of 25% that seem out of nowhere, which is something that we had in 1930. Something called the Smoot-Hawley Act was implemented in 1930 that gave us exorbitant tariffs, which anytime you put on tariffs, that just slows down global trade. I think it's kind of obvious if you think about it. Um, Slowing down world economies, you're going to slow down GDP, which is essentially the transfer of goods for monetary value. I think that slows down as well. But let's look into the Smoot-Hawley Act. Shield your eyes. This is going to turn really bright. So this bright screen here has the U.S. average tariff rates from 1821 to 2016. this is where the Smoot-Hawley Act was in the 1930s. It was implemented somewhere around here that spiked up the tariffs, at which in 1934 we had to have a trade agreement to kind of revise some of those tariffs and kind of have them taken off. And the blue line here ends up being, global imports, or maybe it's U.S. imports. We had a spike up of imports, but then as imports started to slide down, they started to try to take tariffs away because it was slowing down too much. So obviously impacting global trade, as that is slightly earlier than that, and it started to trail down, and they chased it down. And then you have right here World War II, that made global trade even worse. And here we have the idea of the estimated Trump tariffs after they're implemented is somewhere right around where the Smoot-Hawley Act was enacted. So are we coming full circle? Are we coming full circle? We're going back where we came, basically, kind of doing the same thing that we were doing back in 1930s that led to global trade slowing down to the point where we had a Great Depression. Wikipedia page has the Tariff Act of 1930, also known as the Smoot-Hawley Tariff Act. It's supposed to be a protectionist trade measure, but it raised tariffs on 2,000 imported goods in an effort to shield American industries from foreign competition during the onset of the Great Depression, which started in October of 2029. I guess that's the way that history wants to repeat it, but if you look at the legislative history, this was introduced to the House of Representatives in April or May of 1929, so that is even before the top of the stock market that ended up happening in July, I do believe. And it was signed into law June 17th, 1930. Remember that date, June 17th, 1930, and we'll look at that exact date on the chart. First, I wanted to show you Mr. Smoot and Willis Hawley. Look, these fucks. They don't give a fuck about you. They wanted to sign their protectionist bill to, just to pass a law, I guess. But yeah, totally screwing up the world economy there. Good job, guys. Good job. You screwed the country for a solid decade, I would say, and potentially led to a world war because of this protectionist idea. Good job. So June 17th, 1930. Let's look at that on the chart. Here we have the weekly chart of the Dow Jones Industrial Average from 1929. Let's check where the peak was. Right there, September 2nd of 1929 was the peak. And they introduced that law, or they tried, getting it passed way before that. But it went through the House of Representatives, went through the Senate, and eventually gets passed May, June, right around here on this drop right here. So after they passed that Tariff Act and the tariffs were enacted, you just had a very nice downtrend, which was the crash of 1929, which started in 1929, had a very nice reactionary lower low from there, which led to a lower high, which was a back test of that area, which is very neat to see that distribution swing failure come down. This is a pattern that we see often in markets. Just draw a box around that distribution area right there. Same way we do all the time. Distribution, swing failure, head and shoulders pattern up there, and broke right through the bottom, back tested it, and down you go. So tariffs may have been to blame for this. This was definitely a stock market crash, but interrupting global trade with tariffs led to this. That wasn't just leverage getting out of the system. This was the flush of leverage. This was economic hardship. At least that's the way it looks to me. So now we have to compare what went on then with what's currently going on now. So as a comparison, top to bottom, top chart is the 1929 stock market, and down below is current stock market on a 2-week chart. So the 1929 chart is a 1-week, down below is a 2-week. But you can see the similarities going on there with 419 bars, 419 weeks basically from the lows of 1921 to the highs of 1929. And the same thing down on the lower chart, 2-week chart. We have a low in 2009 and 416 bars to the current high. And 594% gain. 1929 we had a 505% gain. So there's some rhyming going on here, and even the patterns kind of match the same. In 1929 you had the kind of double bump and run, and currently from 2000 to 2009 double bump and run. And this came down to break the lows of the double bump. Who's to say we can't do that now? Into the next cycle low and take out those lows. Maybe it leads all the way till 2029, and that would, be a 100-year cycle basically from top to bottom, bottom to top, whatever. Could be a 100-year cycle, 99-year cycle. Maybe we're just coming full circle. Point being is we have a candidate here for potentially heavy downside. And I don't think many would expect the price of the Dow Jones to go, sub 10,000, 6,000. But chart patterns that repeat, they repeat for a reason. We have similar things going on today that we had in 1929 with regards to crowd participation. This was kind of the advent of leverage getting started in the system back in 1929, kind of a large misallocation of capital, where the idea was, well, you just throw your money in the market and you make money. You just sit on your ass and make money. It's kind of similar to what we got going on here, where you have the advent of digital, the ability to trade on your phone anywhere you want. And a lot of the rhetoric is, well, you just buy and hold and get rich, bro. If you look at the history of 1929, there were a lot of people that would like not go to work, and they would stand around the stock ticker and wait for their ticker symbol to come up so they know if they're up or down for the day. And as we see on X and on social medias and stuff, people are looking at their portfolios constantly currently today. It's a very similar scenario where people want to see their portfolio rising because they bought and they just expect up, up, up. But the chart pattern, could be playing out something very similar here, especially if you have this leg move down. This leg breaks the lows of 2022, and that would look very similar. Then you'd have a retrace for like 6 months, and then the continued downtrend, because you would have a lower low, lower high scenario, and you're not going to break that until you make a higher high, higher low, and change the trend. Like was done back in 1933, over here you change the trend, and the reciprocal trade agreement was signed right there in 1934, and the markets went up ever since. So that helped get global trade back on track. So, are we looking at something like that pissing off the side of the roof, breaking previous lows? That's possible, and arguably being done on purpose. Like the tariffs were not, they say reciprocal tariffs because there's tariffs put on the US, but at no point have I seen or heard about the president or any of his advisors talking to other countries and asking them to remove tariffs. It was just, well, we're going to put on reciprocal tariffs and then we'll see how it shakes out instead of trying to negotiate beforehand. So it seems like they're taking the more painful route, and that could lead to a repeat of this whole scenario. The double bump, run, crash, double bump, run, crash. What does gold do there? Gold held up pretty well during this time. It actually stayed pretty stable, and from the lows, it actually went up like 85%. What's Bitcoin going to do? We will see. I mean, it's kind of designed for this type of moment, but who knows? There's not enough history there to say. But it is an uncorrelated asset to just about everything else, so it's got a shot. So let's start zooming in here to stock market peak of 1929 and start zooming into what we have going on today and kind of look at the anatomy of the crash and how it kind of progressed. Get it real tight to this, and we'll see how far did that initial leg down go. Peak to the low, that was 17% down before any bounce. So it took the liquidity from the previous low, it made sure to close a lower low, then gave you the lower high, and then subsequent crash. Let's see where we're at now, currently today. From high, low, we're currently at like 15%. So what if it goes down, 17, 18%, closes below those previous lows, giving you the lower low, lower high comes in, and then a real crash sets in, and that's down 50% from all-time high. So if you have something similar happen where it bounces, but it closes that lower low, then this moves down some 50%. And that takes out all of the liquidity since the COVID crash. And you're breaking below the 2024 lows. And then potentially you get like 6 months, 5 or 6 months of sideways up there. And then 2026 is really bad, maybe. So you look for the trend and how the trend will remain your friend until you start having small shifts there in the trend that lead to bigger shifts in the trend. You get a lower high, lower low, lower high scenario that leads to a monthly lower low and a monthly lower high. And then you're in a real bear market, which we have not had since, well, basically this sideways stuff from 20 years ago. And maybe it's time that the 18.6-year cycle plays out. It's a little early for it, but everything else matches. Like this pattern up matches. Everything looks to be complete, and we've got divergences on many time scales. So I'd say there's a distinct possibility that this ends up being way worse than anybody can imagine, but it all starts with trend. And right here, if this just pushes down a little bit further, you're going to be closing below, April and May of 2024. So that's 1 year ago, and you'll be trading lower than there, potentially closing weekly candles down there. That leads to a lower high, and then you get a lower low, sweeping all of that liquidity. If so, then you have the anatomy of a crash and a very, very severe economic conditions going on until people smarten up and start opening up trade, I guess. Is this confirmed that's going to happen? Is it a guarantee? Not at all. It hasn't even confirmed below, 20 April and May of 2024. Haven't even confirmed below it yet. But if it does confirm below it, I'd be very, very cautious. at a potential head and shoulders pattern playing out here and a very large drop coming fairly soon thereafter. That'll look like a crash before you have sideways chop for months at a time. So that could be the potential trade setup that's going to play out, in the next year, year and a half. It's kind of what I've been expecting for the past year to 3 years. It's kind of coming to fruition. It's setting up like it's going to happen. So just got to be careful. For those of you that may have not seen any of my presentations before, I'm going to zoom out to the monthly chart here on the Dow Jones and kind of show the way that I tend to look at the patterns. I'm looking at this as ABC complete. That completed itself right there. Measures real good, measures to the 1272 fib extension of that leg. Then coming off of there, you have this ABC, you have this ABC. One final move, that's your target wave. So that kind of completes this pattern in a sense. And what comes next is anticipated to be whatever came before the pattern, which would be the 1929 leg down for like 2.5 years, 3 years. That would be the expectation just based upon the pattern. Does it have to happen? No. Is there a setup that says that happens? Yes. Is there a buying opportunity if this does happen? Yes. Measure the leg from 1929, get the 1-to-1 fib extension, which should get you down to $6,000 on the Dow Jones, which sounds ridiculous right now, since we're trading at 38,000 with a current all-time high of like 44,000. But that would be a buy setup. And coming out of there, I would expect that leg to repeat and sideways. So that would be a bounce that would look like a lower high. And this would be your money printer going bananas. That's what it would look like to me. The whole leg down is just stubbornness, that purple leg down, stubbornness to print money, fear of inflation, so inability to print money, or maybe lending, just nobody wants to lend money to bring money into existence, or the treasuries, they're not able to issue treasuries because nobody will buy them. Interest rates may go way higher than we expect to try to get people to buy those treasuries. A whole slew of things could really come into play here that makes it so money printer does not come until 2026, 2027, maybe 2028, possibly, just to match the purple legs there. And we can get a target for that leg down if this is indeed the top. Still don't have confirmation of the top. You still do have small leg here that could be matching, and you have another push up, but you do have very large time frame divergences on a monthly, on a 3-month, on a 12-month chart. These are diverging. There's a lot of divergence here from the RSI. So if it has topped and this leg does repeat, looking for the buying opportunity at the 1-to-1 fib extension, or at least the 786, which would be $8,000 to $5,000 on the Dow Jones. And that would go in line with Elliott wave theory, where you would have, let's just draw it out. We'd have a completed wave 1, 2, 3, 4, 5, a very extended wave 3. You have 1, 2, 3, 4, and an extended 5th wave in wave 3, which makes sense. So then we would have that being your wave 3, and this coming from, not 1900s, turn of the century, wave 1. Your stock market crash of 1929 is actually wave 2. All of this is wave 3 of the larger degree. Then you would have wave 4 come back to wave 4 of lesser degree before pushing up for wave 5. That would probably take 50 years to complete wave 5, if I had to guess. It's probably going to take some time. But very common for Elliott wave theory when counting these waves, for wave 4 to come back to wave 4 of lesser degree. And your wave 5 target, that could be anywhere when the money printer goes crazy. Sometime in 2080 or something, 2060, you end up having a $250,000 Dow Jones or higher. You never know. I mean, that could fully extend way higher than that. And maybe money is worthless at that point. But this is the pattern that I'm kind of seeing. If this is indeed 1, 2, 3, 4, 5, wave 4 comes back to wave 4 of lesser degree, push up for wave 5. Very long time frame ideas. They definitely don't have to play out. They are just patterns that I see repeating over and over, especially the psychology that's been going on over the past few years with misallocation of capital. It's really going into frivolous things or even fraudulent activity. You got your rug pulls and stuff in crypto. You even have some rug pulls in traditional finance, like those SPACs that were going on in 2021. That was a scam, and everybody knows it was a scam now. And now you've got another push up for like a distribution here. Swing high, maybe it swing fails over the long term. If you do come down and like cut half of the COVID crash low, that would be a major, major warning sign for things to come. You'd have a lower low on like a monthly or even a 3-month chart. Expect the lower high, expect the head and shoulders pattern, and that's a macro time frame reversal that comes into the cycle lows that you would look for on the macro. So you have the M shape and then cycle low. You probably have something similar to that, and it might come down pretty deep. That's what I'm kind of looking for if patterns start confirming and giving you macro lower lows. So definitely be cautious. You don't want to blindly be buying the dip, especially the dip that keeps on dipping, because this in the next few months it could be down 50%. And that crash might seem like, well, the stock market's down 50%. That's an obvious buy signal. And then it just treads sideways for a while and then continues the downtrend for like 2 or 3 years. And that would be, an 80% decline potentially, 70 to 80% decline. The targets that I'm looking for measuring, the 1929 crash are contingent upon, the inflation that we've had. Maybe that pattern doesn't repeat perfectly and it ends up falling short of the 1-to-1 fib extension just due to the devaluation of all the currency. But I could say if it does come down there, sweep that liquidity down there, that would be a buy setup, and expect a very large bounce and money printer coming in like crazy. So let's bring the video back full circle and just contemplate, are we bringing the U.S. economy back full circle when the U.S. got global reserve currency status and the Federal Reserve was kind of started a little bit before this, and this is when they got their full swing. Are we coming full circle? Tariffs, tariffs, crash, crash into money printing. I don't know. It gives a compelling argument, just based on the timing of this, the lunar cycles, the monthly cycles, 360 degrees, how the misallocation of capital is happening, similar to 1929. We have the tariffs it just seems like we're coming out of this the same way we came into it, giving you a full circle. So that's my thoughts on the macro. It doesn't look good, but expect some bounces to come, and then just watch your trend. The trend is going to be your friend in either direction. I think buying opportunities are going to come in probably a year or two from now, but currently I think it's risky. I think there's been a lot of distribution, a lot of selling. You have Warren Buffett that's holding record cash, and I doubt he's looking to jump right back into the markets. I think he's pretty happy with his cash pile. And if he's happy with his cash pile and you have that drop like 1929, I think Warren Buffett's a buyer down there. S&P 500 to take out those lows would be like $700. So yeah, that looks like a bargain. Whereas right now everything looks overvalued. Everything looks like it's in the expensive area, especially if you look at the channel that I kind of put out in previous videos. You're at the expensive areas. Expensive, expensive, expensive. This is the cheap line, the trend line down here. That's where things are inexpensive. So you buy these dips all through the bottom. So yeah, hopefully you can keep your stops tight and have a good night, and we'll kind of keep tracking this as it progresses here on the monthly charts. Hope that was helpful, guys.